with AI stocks going up so much over the last year, it's becoming very challenging to find an AI company that's actually cheap, that's actually undervalued, that could potentially deliver crazy returns over the next few years, and none of it is potentially priced in the stock. But a lot of you have asked me about the stock called ZETA. ZETA is a very interesting AI stock, in my opinion. It's down 28% over the last year, and it kind of reminds me of whenever I was buying hims and hers at $7 per share. The metrics are very similar. The setup, 3 times sales, growing sales 30%, misunderstood story. There's a lot of things to be excited about, but there's a few things I don't really like about the company. So I'm gonna analyze it in this video, and I really hope you enjoy it as always. Now, in this digital economy, I would say that data is king in general, and ZETA has access to over 245 million individuals they're seen monthly, and this is over 90% of the US adult population. And they partner with companies like maybe Google or a lot of the big seven, also a lot of other smaller businesses for marketing. So they help them optimize their marketing strategies to deliver sales growth and to deliver better performance for those other companies. It's a little bit of a tricky business model, but this is essentially what the company does. And they use AI to do it. 90 to 100% of their operation is through AI, but the numbers really speak for themselves because the company has grown revenues at a 28% CAGR since 2021. So it's really hard to fake it. So if those companies were not finding success from ZETA, using AI to deliver all those things for them, the company would not be growing so much. And the growth is reaccelerating from 25, 32% growth, 31% growth. So this is very interesting in my opinion, especially relative to the valuation, which I'm going to talk about. But if you look at their total customers, and this is divided by scaled customers and super scaled, which customers that spend over $1 million, those customers have gone up from 76 to 168, and the smaller customers, they went up from 267 to 399. It's been very steady growth. And again, if those companies were not finding results, they would not be choosing ZETA as their marketing partner. But what I really like about this company is the confidence that they have in those earnings report. I mean, if you look at them, they look like they have a lot of confidence. Like they say, our growth is predictable. How is it predictable? Well, it's mainly predictable because they have such a deep relationship, long-standing relationship with a lot of the big players. They keep using ZETA every single year, and their average revenue per user increases sequentially every single year. The longer they stay with ZETA, the more money ZETA makes, and ZETA can foresee the revenues over the next 3 to 5 years, as most of it is recurring revenue that they get from those companies that have been using ZETA for many years, and now they're using 100% AI to generate whatever they do for those companies. So this is why they have so much visibility. And again, it's pretty amazing. And if you look at the company's track record, they have a track record of beating the estimates or beating actually their own guidance. So they always under-promise and over-deliver. This is the model that the company has implemented, and they're still executing on that. And if we look at the last guidance, they said since going public, we have consistently done what we told investors we are going to do. I just love it. And looking at guidance, they had $1 billion in revenue for 2025. It's going to come out at $1.25 billion. Pretty amazing. Adjusted EBITDA was supposed to be 200, now it's 265. Free cash flow was supposed to be 110, now it's 142. Looking at 2028 guidance, it's going to jump from 1 billion to 2.1 billion. So this is a double in revenues in pretty much 3 years. Free cash flow is almost expected to triple from 110 to 340 million plus. And again, ZETA will likely revise those estimates upwards as we get closer to 2028 because they always under-promise and over-deliver. So it's a very interesting AI bet, in my opinion. They have very high gross margins, around 60% gross margins, very sustainable, very profitable business. The company just became profitable on a non-GAAP basis. They just turned EPS profitable. They were losing a lot of money and it's been improving. Now they just turned positive. Again, very much like HIMS in 2023 when I bought it. It was losing money. and they just turned profitable, and then ultimately they got a multiple expansion. But while the company is turning profitable, their stock-based compensation expense has been steadily going down. It was 298, 242, 194, 178. Now it's still high, but revenue is growing in general, gross profits are growing in general, and ultimately net income will be much higher than stock-based compensation, and it's not going to really matter anymore. But it's been going down steadily, and I love the discipline from the company very much. The company also has more cash than they have in debt. So they have 365 million in cash, and they only have 196 million in debt. So the company has everything you want in a growth company: very high gross margins, sustainable revenue growth, predictable revenue growth. They under promise, they over deliver, and the stock is down over the last year. It's very surprising to me, and it doesn't really happen very often. Now, if you look at everything I showed you, 30% revenue growth, net cash position, the company just became profitable. They're guiding to double their revenues over the next few years. What do you believe this company is trading at? Maybe 5 times sales, 7 times sales, maybe even 10 times sales as an AI bet. Well, it's actually trading at 3.5 times sales. 3.5 times sales for the things I just told you above is really dirt cheap for the company. It's extremely, extremely cheap. And I believe it's mainly cheap because the market has some doubts about the competition. So they compete with Salesforce and they compete with a few other companies. So maybe the market believes that this growth is not sustainable, and they're pricing ZETA at 3.5 times revenues. In my opinion, ZETA with such metrics should be at least 5 to 7 times revenues for such 30% revenue growth and amazing gross margins, and they just turned profitable and good discipline. I think there should be 5 to 7 times sales easily in this market, but it's trading at 3.5 times because of the competition. But based on what I've seen, ZETA has access to something called first tier data. Most of those marketing companies have second and third tier data, but because of ZETA's access to 245 million people, and because they use 100% AI, it's the only company that's using 100% AI, and their marketing strategies are very effective. They have better quality data in general. So I believe they have some kind of a competitive advantage. Also, maybe it's not really a deep moat, but you could say a good competitive advantage. Now, I told you guys about the company's guidance for 2028, which is 2.1 billion. But now I'm going to take in the 2030 number to make in a 5-year estimate. And I told you that the company is expecting to, again, double over the next 3 years. But I took in a contraction in revenue growth, and I put in 2.1 billion, assuming they hit it for 2028. And for 2029 and 2030, I assume that the company only grows 15% in sales. I think this is achievable. They've been growing 29, 30% in sales. I think 2029, 2030, they should at least grow 15% in sales. Now, if we use that, we get about 2.77 billion, around $2.8 billion, you could say, in total sales. And here I just rounded up to 2.7 billion. Now we have 3 case scenarios. We have 3.5 times sales, meaning no multiple expansion, no multiple contraction. We have 5 times sales, which I think is more likely once the market realizes that ZETA has a competitive advantage. And that's why those big customers, they've been using them for decades, and more customers keep on using them. And then we have 7 times sales, which would be maybe the best case scenario. Now, in the base case scenario, this is again excluding dilution, which we do have some dilution, unfortunately, and it's been going less and less over time as the company just became profitable. And as they become more profitable, they're ultimately gonna likely be buying back stock to offset stock-based compensation. And I don't believe shares outstanding will keep ballooning forever, especially in 2026 and 2027. But excluding that dilution, I'm seeing 99% on the upside. So I'm around a double over the next 5 years. No multiple expansion or contraction. This is not bad at all. 5 times sales, I'm seeing 185% on the upside, much better. 7 times sales, up to 300% on the upside over the next 5 years. And this is again including 15% revenue growth in 2029, 2030. And maybe they're going to grow 20% or 22 or even 25%. So I think ZETA, in my opinion, is very interesting as an AI stock. And it's mainly in the marketing space. It's a little bit more competitive. That's why it has a lower multiple. But I think the multiple is too low for a company that has such visibility, that has underpromised and over-delivered for such growth of 28% CAGR, with the growth reaccelerating and no signs of slowing down. I think 3.5 times sales is cheap, and it likely provides a, you could say, some kind of a downside protection on the stock relative to other hyped up AI stocks in this market. So I think ZETA is very interesting. I like the stock. I'm going to keep researching it. And I decided to share it with you guys on YouTube and let you know my opinion. So that was my opinion on ZETA. It was not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.